Today, Powell's tightrope walk. Hello again, it's Martin North from Digital Finance Analytics World, latest posts covering finance and property news with a distinctively Australian flavour. Yesterday I warned about higher market volatility given all the moving parts at play at the moment. Well, we saw that in action again on Tuesday as Fed Chair Powell gave evidence at the Senate Banking Committee. Back in December, Powell said that one of the two big threats to getting back to maximum employment is actually high inflation. And he stressed that getting back to pre-COVID levels of labour force participation would require a long expansion, which couldn't happen with runaway price growth. This marked a shift in how he discussed the trade-off between wanting to see greater improvement in the labour market and tolerating persistently elevated consumer price growth. So his new line is that increasing interest rates and tightening monetary policy is actually a benevolent move on the Fed's part. And this very same line was in evidence again on Tuesday when he said, in a way, high inflation is a severe threat to the achievement of maximum employment.
Moving up is generally a good thing, but if you look back through history, there are times when wages have moved up in a way that has fostered persistent inflation, and that hurts everyone. It particularly hurts people on fixed incomes. So we don't see that right now, but we do see these are the biggest wage increases in decades, and so we're watching carefully. And to the extent we are looking at this year, what we see is an economy where the labor market is recovering incredibly rapidly, really beginning around the middle of last year. The unemployment rate's been dropping at more than 0.3% per month since last June. It's now below 4%, which is pretty close to half-century lows. So that part of the employment market is doing very well. Meanwhile, inflation is running very well, very far above our target. And what that's telling us is that the economy no longer needs or wants the very highly accommodative policies that we've had in place to deal with the pandemic and the aftermath. So that's what that's really about. We're really just going to be moving over the course of this year to a policy that is closer to normal, but it's a long road to normal from where we are. Right now we are very highly accommodative, and it is really time for us to begin to move away from those emergency pandemic settings to a more normal level. It really should not have negative effects on the employment market.
We think wages moving up is generally a good thing, but if you look back through history, there are times when wages have moved up in a way that has fostered persistent inflation, and that hurts everyone. That, of course, is what happened in the 1980s. Now, that is at one level a deft move on the part of Powell, who's earned respect from both Democrats and Republicans for their response to the onset of COVID-19. Yet more recently, members of both parties agree that the central bank has fallen behind the curve in containing the highest levels of US inflation in decades. It is a bit of a replay of the 1970s, actually. It's a particularly agonizing headache for the Fed, which had explicitly pledged to keep interest rates near zero until the labour market had reached a level consistent with maximum employment. The economy remains millions of workers short of February 2020 levels, even with a 3.9% jobless rate as at December. So Powell actually did the only thing he could do in that situation: make the case that imminent gradual interest rate increases will help rather than hurt the overall labour market. Now, that's a fine line, of course, given that tightening monetary policy by definition dampens demand. We can begin to see that the post-pandemic economy is likely to be different in some respects, he said in his prepared remarks.
4 years ago, when I sat before this committee, few could have predicted the great challenges that would soon become ours to meet. On the eve of the pandemic, the U.S. economy was enjoying its 11th year of expansion, the longest on record. Unemployment was at 50-year lows, and the economic benefits were reaching those most on the margins. No obvious financial or economic imbalances threatened the ongoing expansion. But this attractive picture turned virtually overnight as the virus swept across the globe. The initial contraction was the fastest and deepest on record, but the pain could have been much worse. As the pandemic arrived, our immediate challenge was to stave off a full-scale depression, which would require swift and strong policy actions from across government. Congress provided by far the fastest and largest response to any post-war economic downturn. At the Fed, we used the full range of policy tools at our disposal. We moved quickly to restore vital flows of credit to households, communities, and businesses, and to stabilize the financial system. These collective policy actions, the development and availability of vaccines, and American resilience worked in concert, first to cushion the pandemic's economic blows, and then to spark a historically strong recovery. Today, the economy is expanding at its fastest pace in many years, and the labor market is again strong. As always, challenges remain. Both the individual shutdown and the subsequent reopening of the economy were without precedent. The economy has rapidly gained strength despite the ongoing pandemic, giving rise to persistent supply and demand imbalances and bottlenecks, and to elevated inflation. We know that high inflation exacts a toll, particularly for those less able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to achieving our statutory goals of maximum employment and price stability. We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We can begin to see that the post-pandemic economy is likely to be different in some respects, and the pursuit of our goals will need to take those differences into account. To that end, monetary policy must take a broad and forward-looking view, keeping pace with an ever-evolving economy.
Now, of course, Powell is clearly still a dove at heart, and he made that apparent through his testimony. He's holding out hope that supply constraints will recede so that the Fed doesn't have to fix the economy's supply-demand imbalances solely through the demand side. This just so happens to be a view shared by President Joe Biden.
Economist lingo tends to mask what we're really talking about when it comes to the Fed's work. So let's be clear. President Biden put it pretty well last week. Taking the example of the price of cars, he said we have two options. We can increase the supply of cars by making more of them, or we can reduce demand for cars by making Americans poorer. That's the choice we face. When people talk about cooling off the economy, what they really mean is making it harder for people to find jobs and stopping paychecks from growing. And we know how this goes. The cooling off never seems to extend to corporate profits or executives' pay. The Fed must not allow only Wall Street to recover while working Americans are left behind. We've seen that story unfold far, far too many times before. Today, banks are quietly celebrating one of their most profitable years ever, with huge bonuses and payouts. The Fed must do more to stop consolidation in the banking industry from hurting consumers and small businesses. It must encourage more lending to Main Street and crack down on stock buybacks and risky bets at the biggest banks. And the Fed needs to take seriously the systemic risks that threaten our economic progress, like cryptocurrencies and stablecoins, and most importantly, climate change. Chair Powell has shown he understands, in his words, profound challenges for the global economy and financial system, unquote. If confirmed, we expect him to take what he's promised will be bold steps to tackle these risks.
And believe it or not, there's a lot of people in the second camp. Now, that might be a bit hyperbolic, considering the Fed's current projections don't even have the Fed funds rate at the neutral level of 2.5% by the end of 2024, with inflation-adjusted interest rates still deeply negative and a balance sheet that's still growing. It's hard to make the argument that the central bank is on the verge of constraining the economy meaningfully. As I've said before, you've got to look beyond the words to actions, and so far the actions from the Fed have been, well, crickets really. But make no mistake, monetary tightening is coming soon. Powell has carefully not given anything away about the timing of the first interest rate increase, but his colleagues are doing it for him. So far this week, Atlanta Fed President Raphael Bostic said that starting to raise rates in March may be appropriate. And Cleveland Fed President Loretta Mester said she'd support moving rates higher in March if the economy looks like it does now. And Kansas City Fed President Esther George said it's time to transition policy to a more normal stance. Now, as a result of all this, stocks gained and Treasury yields dipped in the wake of Powell's testimony in what seemed to be a relief rally after Goldman Sachs and others made headlines yesterday by floating the idea of 4 interest rate increases in 2022. Compared with that scenario, the Fed's chair seems, well, very dovish. All members of the committee see interest rates increasing this year. The meeting is 3, but it's going to depend on data, Powell said. That is to say, if inflation quickly comes back closer to 2% later this year, the central bank may pause any further tightening. Of course, the flip side holds true as well. There are risks on both sides, Powell said. That's not helpful, of course, for investors looking to gauge the market's next moves, but Powell's comments were meant entirely for lawmakers on Capitol Hill at the start of a midterm election year. For Democrats, he pledged that the central bank would remain committed to seeing job gains reach segments of the population that have historically taken longer to find employment. And for Republicans, he vowed that policymakers would bring about a return to price stability. So you can see here the Fed being highly political. There's only one way to reconcile those two points of view, and that's through the argument that Powell continues to make about inflation threatening maximum employment. It helps that he's correct, but it won't make navigating a potentially choppy 2022 any easier atop the central bank. And so US stock indices gained ground on Tuesday, with the Nasdaq leading the advance as investors appeared relieved that Federal Reserve Chair Jerome Powell's testimony to Congress did not include any major surprises. Of course, his confirmation of a second term as head of the US Central Bank is what it's all about. And he said that the economy should weather the current COVID-19 surge with only short-lived impacts and was ready for the start of tighter monetary policy. After falling just under 1% earlier in the session, the interest rate-sensitive technology sector bounced back to rally almost 1% and provide the S&P with its biggest boost. The market is extremely in tune to the Treasury yield move right now. As yields have started to slow down their ascent, that's providing support for technology-related stocks, said Matt Miskin, co-chief investment strategist at John Hancock Investment Management. There weren't any real surprises to Powell's comments, which is perhaps adding some stability. While Miskin saw some signs of a risk-on market on Tuesday, he said investors were also tiptoeing around as they waited for key inflation data, which is due out on Wednesday. The headline consumer price index is expected to come in at a red-hot 7% on a year-on-year basis, and that, of course, is expected to influence the Fed's plans for interest rate hikes. Information technology stocks led the way higher on Tuesday, following up on historic reversal for the benchmark that began intraday Monday, as more subdued tones on Treasury yields gave way to a rally in those areas that are more susceptible to an eventual lift-off in yields. In a Tuesday confirmation hearing, Federal Reserve Chair Jerome Powell painted a picture of a soft landing for the economy as the central bank moves to remove emergency stimulus measures and begins raising interest rates, even as market participants increasingly expect the Fed to move much more aggressively than previously anticipated after inflation proved hotter and much more persistent than policymakers had predicted. The Nasdaq Composite rose 1.4% to 15,153. The S&P 500 closed up 0.9% to 4,713, and that was aided by a 3.4% gain in the energy sector and a 1.2% gain in tech. And the Dow Jones Industrial Average finished up 0.5% to around 36,252. On Monday, the Nasdaq's composite reversed from a 2.7% intraday slide, which was the strongest such reversal since February 28, 2020. And the late-day reversal was driven by companies that had seen the worst year-to-date performance according to Bespoke Investment Group. The 10-year Treasury note was down 1.89% to 1.746. Rising interest rates have been part of the dynamic that has weighed on stocks in recent days since the Fed's so-called hawkish pivot. Equity markets have been battered since the start of this year after the minutes from the Fed's December meeting pointed to a sooner than expected rise in interest rates due to rising inflationary pressures. Marko Kolanovic, chief global market strategist at JP Morgan, said that the recent pullback in riskier assets arguably was overdone and called it a buying opportunity. 8 of the 11 major S&P 500 sectors rose, with growth-heavy sectors like technology and consumer discretionary contributing most of the S&P's gains. The biggest percentage gainer was energy, which rose along with crude oil futures. Mega-cap growth companies including Apple and Amazon were the biggest single stock boosts to the S&P 500, with Amazon up 2.4%, Apple was up 1.68%, and Airbnb rose 4.92%. Also on investor watch lists for this week is the unofficial start of the fourth quarter earnings season on Friday, with big banks expected to show an uptick in quarterly core revenue thanks to new lending and firming Treasury yields. IBM, though, was down 2.7% after UBS downgraded the stock to sell and slashed its price target. And vaccine maker Moderna was down 4.7% after rising more than 9% on Monday. Pfizer vaccine partner BioNTech was also down 4.6% on Tuesday. The World Health Organization said more research is needed to find out if existing COVID-19 vaccines provide adequate protection against the Omicron variant. And that's where Cathie Wood, the star fund manager and chief executive of ARK Invest, in a Tuesday monthly market update, said that the used car market is where she's expecting possible losses after a surge in values. She said that she wouldn't be surprised to see a bloodbath in the used car market, with valuations tumbling in the coming year into 2023 as prices that have surged because of supply chain bottlenecks and a pop in demand recede. We'd submit that they might be looking at losses, Wood said, referring to car companies that manage to outperform electric vehicle manufacturers such as Tesla, which is considered the vanguard of the EV wave last year. The comments that Wood made on Tuesday were actually similar to those that she expressed via a video released by the company earlier in the week, where she cited rising inventories of used cars, among other things, as evidence that values will tumble in the coming year and hurt sales of new vehicles as well for traditional car makers like General Motors and Ford. The monthly update from Wood and her team at ARK Invest come amid a brutal stretch that has compelled the operators of the ARK Invest ETFs, including the flagship ARK Innovation ARK Fund, to do some soul searching. The fund manager is sticking to her game plan, though. ARK's 7 ETFs returned an average of 141% in 2020 on the back of gains from companies such as Tesla and Teladoc Health, making Wood the toast of Wall Street. But she's had a tougher time in recent months. Still, on the monthly seminar, Wood said that one problem is that investors and analysts have been short-sighted and are not thinking at least 5 years into the future. They're not looking forward 5 years out. There's a lot of muscle memory dictating what's going on, she said of the flight out of some of her popular disruptive innovation themes. So while the fear index is back a little, down 5.1% to 1841, gold lifted to 1,821 US, indicating again the cross currents in the market. And crypto was a little stronger, with Bitcoin up 2.3% and Ether up 5.24%. None of that really means much at all. And as I continue to underscore, the level of volatility we should expect to see in coming weeks will remain very high as we oscillate between expectations of interest rate rises coming quickly or slowly, and as the Fed tries to thread the needle or walk the tightrope between lifting rates too soon and not doing enough. That is a very hard path to trace, and as a result, volatility will rule. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.